Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in tonight's video, we're going to go over all of the opening, closing, and adjusting trades that we had for Tuesday, May 5th. We didn't have any trades yesterday, Monday, May 4th. So we had two of each today. So two opening trades, two closing, and two hedge or adjustment trades to current positions. So let's start with the new opening trades. Both of them are earnings trades. We're not going to slow down with earnings. Going to try to get as many earnings trades as we can into the market in the next 2 weeks as earnings season kind of wraps up here. But it's going to be pretty crazy this week. There's a lot of companies announcing. Didn't have a chance to get into a position in Herbalife, which is okay, because actually the pricing wasn't that great. We were trying to stretch a little bit for pricing, and I just don't think that that it would have been a good position, taking in a very small premium on the position. So we're trying to stretch it a little bit, see if we could get filled today. We didn't, so Herbalife is really the only one on our radar that we didn't get filled on today that we would have liked to, but it's okay. So the first position that we got into was an iron condor in Groupon. We, of course, did the weeklies in both cases, both in EA and in Groupon. With Groupon, since it's such a low price stock to begin with, it's a little bit hard to get really wide. So you can't get, an iron condor that's $8, away or $10 away. The stock's only, worth about $7 to $8 anyway. And so what we ended up doing is doing a variation of an iron butterfly. So we did the 7 and 9 call spread, so a $2 wide call spread. And then we did a slightly smaller put spread, just adding a little bit of skew to the bullish or to the bearish side in case Groupon really kind of crapped the bed and moved considerably lower. The stock's been trending lower, so we just wanted to skew it just a very tiny bit to the downside, just to reduce our risk a little bit if Groupon did make a huge move lower. But even still, we took in an overall credit of about 85 cents, and that really helped out because that got us beyond the expected move for Groupon. So here's a look at the setup. Implied volatility over the 50th percentile at 56%. Definitely is a stock that has really great IV drop or an IV crush, but has been known to make a very large move. So we obviously wanted to be a little bit careful. And again, we kind of tilted this a little bit towards the bearish side because the stock's just been in a really strong downtrend for the last, 2.5 months or so. So just a very slight negative skew. Now here's our position. It looks like a butterfly spread, but it's an iron butterfly. And again, everything's centered over this $7 strike. That's where we ideally like for the stock to move. And you can see that on the put side, we have much less risk than we do on the call side. The call side's a little bit longer, a little bit wider, and that was, again, by design. Now, in the case of Groupon, the stock's trading after hours at about 670, which is right in line with the expected move. And so at least at this point, it looks like it should be a pretty decent trade. We'll see where it actually ends up opening tomorrow. Obviously, the markets can move very quickly in the morning, but at least right now, it looks like Groupon's going to be a pretty good trade for us and a pretty good earnings trade. The next one that we got into today is EA. This is a gaming and kind of technology software play. Had really good implied volatility, very good pricing on the options, which I'll show you here in a second. Went with the strangle, just a completely regular naked strangle. Sold the 64 calls and the 54 puts. Took in a very nice credit of about $115 on EA. Again, the reason that we did the strangle in this case is because the stock is a lower priced stock. It's in the mid 60s, or was in the mid 60s, and so it's not incredibly hard to get margin on it, right? The margin's not going to kill you like a Google or Netflix, which is very expensive. And at the same time, while the stock chart is loading up, at the same time, implied volatility has been really high. So this has really helped out. We wanted to do more of a pure option selling play as opposed to something like an iron condor. So you can see implied volatility in the 81st percentile for EA has a pretty good history of seeing that implied volatility drop, which is what we want to see. And not too many big gaps. I mean, except for last earnings, this thing historically doesn't have too many huge gap moves one way or the other. So for EA, the actual expected move on the stock was right over $4. So we wanted to get outside of that $4 range on either end. Stock closed about 59, so our position is safely $4 above and $4 below. It's actually about $5 above and below on either end, just with our strike prices. And then with the credit that we took in, that also moved our position out just a little bit further. So after hours right now, EA is trading a little bit higher, about 61.35, but it's about $4 away from our closest strike or closest break-even point. So again, same thing with Groupon. Looks like it's going to be a pretty decent earnings trade and should work out barring any big movement in the stock between now and tomorrow's open. Two closing trades I'll cover real quick because they're just very, systematic closes are Iron Condor and DIA. We've closed out for 15-cent debit. Even though these are the May contracts, which only expire in the next 10 days, there's no point to hold these things any longer, at least in our eyes. We've made the vast majority of the potential money we can make on the trade for just this one lot Iron Condor. So continuing to be systematic, close out the position for a $15 debit, made 33 bucks. Same thing with FXI. Went a little bit more systematic on this one and kind of stretched a little bit, trying to get a little bit more premium out of this one. Closed it out for a $10 debit, $36 profit on the position. Again, just being very, very systematic. FXI was actually pretty interesting because it finally moved down, and a pretty big move down today. I think it was down, almost 4% today, and on some pretty decent volume. So now it's kind of trading right inside the range that we've started selling options in. So we actually have seen a lot of our profit in FXI start to really materialize today. And barring any kind of really major move in either direction, if this thing kind of settles down for a little bit, implied volatility drops, it's going to be a great opportunity to take some money off the table and bank some wins. We also did have some adjustment trades that we made today. The first one is in Coach. So Coach is our earnings trade that we had rolled to the next contract month, which is June. And now what we did with our inverted strangle in Coach, and just go back to a couple videos ago and you'll see the inverted strangle and how we made it originally. But now what we did with Coach is we rolled down our call side from 40 to 38, okay? So we moved down the call side from 40 to 38. We did this via a vertical credit spread, okay? We just used a credit spread order to kind of facilitate this roll down. And now we're short the 38 calls and the 42 or 43 puts above the market. So we are still inverted, but now the goal here is to continue to add more credit. So this 75-cent credit that we added brings our total credit on the entire position, including the original earnings trade, to $5.65. So the goal here would be to close out the remaining two options for as close to $5.65 as humanly possible and kind of minimize that loss. And we've done a good job in continuing to add credit to this thing and roll this position down. But the whole idea here is, again, with Coach, is that as the stock is falling, kind of falling away and kind of giving us time here, we wanted to move down our call side from 42 to 40 and then 40 to 38. So we're just continuing to move down that call side. We're rolling it closer and closer. If Coach does continue to move lower, we'll just do the same thing again. We'll continue to move down that call side. Just be very systematic about it. Continue to take in more credit until at some point Coach maybe has some sort of slight rebound or bounce, and then we have an opportunity to take money off the table. So at least at this point, this is what our Coach position looks like. Having rolled down to the 38 calls, we now have a break-even point that's almost at 37 and still our same kind of break-even point above the market, about 44 or just under 44. So you can see very wide range, which we want Coach to trade in now. Between now and expiration, it makes for a good opportunity to get some of this money back from a very bad earnings trade that just went against us. Not a bad trade that we made, but just a trade that went against us. The other position that we had today that we rolled for the second time and rolled it out to the next month is EWW. And this is really just a case study. I can't wait to do a case study on this whenever we end up closing the position, win, loss, whatever. This is a great case study on why we just have to keep extending the trade when shown an opportunity. So we originally entered the contracts back in back in March. We originally entered the 60-61 credit call spread in March of this year, rolled it to April. In March we entered the April position, and then we rolled it to May, and then now we're rolling the same position, same strikes, everything from May to June. Now in the process, we've taken in a credit every single time that we've made this roll, and so our total credit on each individual spread, not on the total, not on all three. So every single one of the three is 33 cents. We started off with, I believe, 15 or 16 cents, and now we've ended up with about 33 cents. So you can see that we're continuing to reduce risk all along the way. And the reason that we're doing this now, as opposed to kind of waiting, is because EWW is starting to rally just a little bit against our position today. And with our strikes right here, this is our short strike right at 60. We're kind of right on the fence here. And at this point, we can roll for a credit. So in my opinion, it's better to roll for a credit and then hope, that EWW continues to move lower. But we've done this now for the last 2 months. So you can see our strike, our short strike right at 60 has really just been challenged. It's been right there, kind of back and forth the entire time for the last 2 months. And so this is where kind of rolling and extending the trade has really helped out. Now, even if this thing goes completely against us, at least at this point, we've basically doubled our credit that we have in the position, and that's going to reduce our potential loss substantially. Again, even if the stock goes against us, but at least we have this extra time to be a little bit more nimble, maybe make another adjustment if we want to, and potentially see an opportunity to make some money in this trade. So I think it's a really cool case study. Hopefully you can follow along with our adjustments in EWW. Again, we kept the exact same strike prices out in June. We just took the entire May position, closed it out, and entered a new position in June. The difference between closing out May and re-entering June was a nice $12 credit on each of the contracts that we rolled out, which were all 3 of them. So we rolled out our entire position. So as always, hope you guys enjoy these videos. If you have any comments or questions, please let me know in the Trading Alerts page right here on the website. If you're watching this video somewhere else out there online or on YouTube, you just have to understand that you're getting this video and these alerts 15 to 20 days after it's sent out to our members. So if you want real-time alerts and a video that goes with those alerts every single night, please, you only can sign up at optionalpha.com. Thanks again.